Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
VLTO is a focused industrial spin-off, separated from Danaher in September 2023. It brought together two distinct but complementary technology platforms: water quality instruments and product coding systems.
The water quality segment includes Hach, ChemTreat, and OTT Hydromet, brands serving municipal water utilities, industrial facilities, and environmental monitoring networks across more than 60 countries.
Hach instruments are embedded in water treatment plants globally as the compliance measurement standard. Utilities test water quality with Hach equipment because regulators expect it. Switching creates compliance risk.
After the instrument sale, Hach earns recurring revenue from reagents, calibration solutions, and service contracts. That consumables model produces margins well above the hardware, driving strong overall segment economics.
The product quality and innovation segment includes Videojet, Lynx, and ESCO, technologies that print codes, dates, and barcodes on food, pharmaceutical, and industrial products in production lines globally.
Videojet is embedded in food safety and product traceability workflows. A dairy company cannot simply stop marking cartons with Videojet equipment and switch. Regulatory and operational continuity requirements prevent it.
Recurring revenue, consumables, software subscriptions, and service agreements accounts for roughly 55% of total VLTO sales, providing earnings stability through industrial investment cycles.
Gross margins across the combined business run around 60%, reflecting the consumables heavy mix. Operating margin sits near 23%, impressive for an industrial company of this scale.
Recurring revenue accounts for roughly 55% of total sales, including consumables, software subscriptions, and service agreements. That base provides earnings stability through industrial investment cycles.
The competitive landscape is fragmented in both segments. In water quality, Hach competes with Endress-Hauser and Xylem. In coding and marking, Videojet competes with Markham-Image and Domino.
VLTO inherited the Danaher business system, a continuous improvement methodology applied across all operations. That operational framework has historically generated consistent margin expansion across Danaher spin-offs.
The competitive landscape is fragmented in both segments. In water quality, Hach competes with Endress-Hauser and Xylem. In coding and marking, Videojet competes with Markham-Image and Domino Printing Sciences.
As an independent company, VLTO can pursue acquisitions in water quality without competing for capital with Danaher's broader life science and diagnostic platforms, a freedom the spin created.
The regulatory tailwind is structural. Environmental testing, food safety mandates, and pharmaceutical serialization rules all require instrument and software solutions that VLTO directly provides to customers.
For investors, VLTO offers recurring consumables revenue, regulatory tailwinds in water quality, and the operational discipline of a Danaher-trained management team running a focused industrial platform.
For investors, VLTO offers a combination of recurring consumables revenue, regulatory tailwinds in water quality, and the operational discipline of a Danaher-trained management team running a focused platform.
That's the company chapter for VLTO. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
What if you could own a company that monitors the safety of the water coming out of your tap, treats the water flowing through industrial plants, and ensures the packaging on consumer products meets brand quality standards, all rolled into one? That company exists, and it trades under the ticker VLTO. VLTO is the October 2023 spin-off from Danaher, and it inherited two of Danaher's highest quality business platforms: water quality and product quality. Today we are digging into VLTO's Q1 2026 earnings, a quarter that delivered a solid beat and reinforced why this spin-off is worth your attention. Lana, give us the overview.
Hudson, VLTO is a fascinating story precisely because of where it came from. Danaher spun it out in October 2023, and it carried with it the Danaher business system. the lean manufacturing and continuous improvement culture that made Danaher one of the most respected compounders in industrial history. VLTO's market cap sits at approximately $21.5 billion, and the stock currently trades near $95 per share. Analyst consensus is buy, with price targets around $105. The company does not yet pay a meaningful dividend but has initiated buybacks. The two flagship platforms are water quality, anchored by Hawk and ChemTreat, and Trojan UV, and product quality, anchored by ESCO and X-Rite. Regulatory necessity and repeat purchase dynamics define the revenue model.
On Q1 2026, VLTO came through with earnings per share of $1.07 against a consensus estimate of $1.02. That is a 4.9% beat, which is the kind of execution that earns credibility for a spin-off still building its public market track record. Revenue for the quarter was $1.399 billion. That number reflects the recurring and mission-critical nature of VLTO's end markets. Water quality monitoring contracts with municipalities are not discretionary. Industrial water treatment chemical programs run continuously. Packaging quality tools are embedded in production workflows. The revenue base is durable, which is why the market is willing to pay a premium multiple for this business, even though VLTO has only been public for a little over 2 years.
Looking at the income statement, the 4.9% EPS beat reflects both top-line strength and cost discipline inherited from the Danaher operating model. Gross margins in the water quality segment benefit from the instrumentation and software revenue mix within Hawk, where recurring service and consumables carry higher margins than initial equipment sales. ChemTreat industrial water treatment chemicals are a repeat purchase business with predictable margins and strong customer retention. Operating expenses were managed tightly, consistent with DBS principles. Below the line, VLTO carries debt from the separation, and interest expense is a real line item, but EBITDA coverage remains comfortable. The beat signals that the standalone cost structure is performing as designed, and that separation disbursements have not materially disrupted operating leverage.
The moat at VLTO is regulatory lock-in combined with deep technical expertise. Municipalities that use Hawk instruments to test water quality do not switch easily. The regulatory frameworks governing water testing specify approved methods and equipment, and requalification takes time and carries compliance risk. That creates a high switching cost environment that resembles what you see in medical devices or lab instruments. ChemTreat benefits from the same stickiness in industrial settings. When a plant has optimized its water treatment chemistry program with ChemTreat engineers embedded in the process, the cost of switching exceeds the cost of staying. On the product quality side, ESCO and X-Rite are embedded in packaging design and color management workflows at major global brands. Ripping out those tools is painful and risky.
Free cash flow generation is healthy relative to reported earnings, aided by modest capital expenditure requirements. VLTO is not a capital-intensive business in the traditional industrial sense. The heavy infrastructure is owned by the customers, municipalities, industrial plants, packaging companies. VLTO provides the instruments, chemicals, and software that keep those systems running correctly. This asset-light quality within a capital goods wrapper means free cash flow conversion is strong. The Danaher heritage reinforces this. DBS disciplines around working capital management, inventory turns, and receivables collection translate directly into cash generation efficiency. As VLTO matures as a public company and pays down separation debt, free cash flow available for capital allocation will grow.
On capital returns, VLTO is in early-stage mode. There is no meaningful dividend yet, which is a deliberate choice to prioritize debt management post-separation and to preserve flexibility for M&A. Buybacks have been initiated, and management has signaled that as the balance sheet normalizes, capital return capacity will increase. The Danaher playbook here is instructive. Danaher used M&A as a primary capital deployment tool, and VLTO has both the DBS integration capability and the management talent to follow a similar path in water quality and product quality adjacencies. The first few acquisitions VLTO makes as an independent company will be defining moments that either validate or challenge the thesis that it can compound like its parent.
3 catalysts for VLTO. First, Regulatory tailwinds in water quality. Governments globally are tightening water quality standards in response to infrastructure aging and contamination concerns. Every new regulation requiring more frequent or more precise water testing is an incremental demand driver for HOC instruments and ChemTreat programs. This is a multi-year government-mandated revenue tailwind. Second, industrial water treatment volume recovery. As global manufacturing activity normalizes from supply chain disruptions, industrial water treatment chemical volumes should recover. ChemTreat has exposure to petrochemicals, power generation, and food and beverage, industries where production normalization is a revenue driver. Third, M&A execution. If management deploys capital effectively into adjacent water and packaging quality businesses using DBS, the compounding effect on revenue and margins can be significant.
Analyst consensus on VLTO is buy, and the price target of around $105 implies roughly 10% upside from the current $95 level. The bull case is well articulated on the street: regulatory-driven recurring revenue, DBS operating discipline, and an M&A runway in fragmented end markets. The skeptics acknowledge all of that, but flag the 25 times forward PE as a demanding multiple for a company with limited public market history. Several analysts initiated coverage after the Q1 beat and have been constructive, citing the quality of the franchise and management credibility. The key metric analysts are watching is organic revenue growth and margin trajectory, which will determine whether the premium multiple is justified over the next 4 to 6 quarters.
The valuation conversation on VLTO centers on whether 25 times forward earnings is appropriate. The bear case says it is too rich for a spin-off with limited independent history. The bull case says it is justified because the revenue model is recurring, the regulatory lock-in creates durable earnings, and DBS disciplines compress execution risk. Comparisons to Danaher's own historical multiple are relevant, and Danaher traded at similar or higher multiples for years while delivering consistent compounding. If VLTO executes on organic growth and begins layering in accretive acquisitions, the 25 times multiple could prove conservative in retrospect. Investors buying at current levels are making a qualitative bet on DS culture and management pedigree as much as a quantitative bet on near-term earnings.
Bull case number 1. Water quality regulation becomes a sustained growth driver. Aging infrastructure in the United States, Europe, and emerging markets is forcing governments to invest in water monitoring and treatment at a pace not seen in decades. Lid pipe replacement programs, PFAS contamination remediation requirements, and stricter effluent standards all point to more HOC instruments, more ChemTreat programs, and more Trojan UV systems being deployed. This is not a cyclical demand wave. It is policy-driven and multi-decade. VLTO is positioned at the center of it, and the recurring revenue nature of the business means that once customers are onboarded, they stay.
Bull case number 2. DBS culture drives consistent margin expansion. The Danaher business system is not a management buzzword. It is a documented set of lean manufacturing and continuous improvement tools that DBS practitioners apply to every business Danaher acquires or operates. VLTO inherited that culture and those practitioners. If the DBS disciplines translate to consistent gross margin improvement and operating expense leverage over the next 3 to 5 years, VLTO can grow operating margins meaningfully even in a modest revenue growth environment. That margin compounding, combined with revenue growth, drives EPS well above current consensus estimates, and the stock re-rates accordingly.
Bull case number 3. M&A accelerates the compounding story. VLTO has a focused mandate in water quality and product quality, and both end markets are fragmented with multiple bolt-on acquisition candidates. Applying DBS to acquired businesses is Danaher's proven playbook, and VLTO management has deep experience executing it. If the company completes 2 or 3 accretive acquisitions over the next 3 years that expand either the water quality platform or the packaging quality platform, EPS growth accelerates, geographic reach expands, and the market assigns a higher multiple to a larger, more diversified franchise. The M&A catalyst is binary in terms of timing, but is highly probable given management's track record.
Bear case number 1. Premium valuation leaves no room for error. At 25 times forward earnings, VLTO is priced for a level of execution consistency that a 2-year-old public company must prove it can deliver. Any organic revenue miss, margin disappointment, or delayed M&A execution will punish the stock disproportionately because there is no valuation cushion built in. Competitors like Xylem and Evoqua have longer public track records and more established relationships with municipal water authorities. If VLTO hits a credibility speed bump, a bad acquisition, a guidance cut, a DBS execution miss, the re-rating could be swift and painful for shareholders who paid 25 times.
Bear case number 2. Separation from Danaher reveals structural challenges. VLTO benefited enormously from Danaher's centralized services, global infrastructure, and balance sheet during its years inside the parent. As an independent company, it must build those capabilities on its own, and that takes time, money, and management bandwidth. The debt load from the separation is a real constraint on capital allocation flexibility in the near term. If any of the acquired DBS talent departs, or if the standalone cost structure proves higher than projected, operating margins could disappoint relative to expectations built on Danaher's own historical margins. The separation risk is real, even if management is executing well on the surface.
The bottom line on VLTO: this is a high-quality spin-off from one of the greatest industrial compounders of the last 3 decades, carrying the right businesses and the right culture into independence. The Q1 EPS beat of $1.07 against a 1.02 estimate reinforces management credibility. Water quality is a regulatory-driven recurring revenue business with multi-decade tailwinds. Product quality tools are embedded in global packaging workflows and benefit from brand consistency demands. The 25 times PE is demanding, but the franchise quality and DBS legacy justify a premium. Buy consensus with a $105 target implies 10% upside from here, and M&A optionality could drive more. The primary risk is execution risk for a recently independent company under a premium multiple. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.